Good evening. I hope everyone is doing well and staying safe. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're going to do another Nordic market outlook based on what we're currently seeing in the market, what research we're paying attention to, and showing you some of the ideas and option strategies that we think are optimal for this particular market. Now, before I go ahead and get started here, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's go ahead and get started. Let's first talk about the current market outlook. I think a lot of people have the same question right now is this a true recovery? Have we bottomed in the market? Or is this just a bear market rally where the markets are going to continue moving lower? So based on the research that we're currently looking at, some of the concerns that we have is the fact that we believe that the subsequent rally that we've had off the 1250 low, we've referenced this 1500 level quite a bit over the last couple of weeks, and we managed to make our way back up to that 1500 level. But as you can see, momentum has really started to slow down. We think that there's a fair amount of risk that the markets do pull back towards that 1150 range. So at this point, we do expect that the market's going to be fairly range-bound. The US markets did push a little bit higher above these resistance levels, but again, these small pushes have been with fairly weak momentum, and we think that there's a higher opportunity or higher risk that the market pulls back into the range rather than continue to move higher. And that's predominantly based off of the economic research that we're doing, based off of the high frequency data that we're looking at. The challenge here is the fact that economic data coming out is slow. We don't have enough economic data to really get a sense for the sense of the impact. So what we're looking at is other type of data sets, such as credit card spend, high frequency data that gives us a better understanding as to really where consumers are spending, where they're not spending, to give us a sense for how much of an impact does this have on our economy to make our decisions. So our feeling at the moment is the fact that there is less likelihood of markets continue substantially higher, that if they do push a little bit higher, that they're more likely going to fall back down, especially given the numbers that we're currently seeing out of estimate revisions from corporations, the credit card data that I'll show you here in a couple of minutes. That is our current view. I'm curious as to see, the audience here, if how many of you have perhaps a similar view. If you can pull up your chat window at the bottom of your screen, and please type either up or down on your chat window, just so I can get a sense for the audience here, what your thoughts are, whether this is a bear market rally and markets are going to continue heading lower, or you think that the markets are going to break out. So please type up if you think the markets are going to break out, and down if you think the market's going to pull back into that range between 1150 and 1500. Okay, so I see a couple of downs here. Seeing someone else saying up. Okay, great. So what we're going to do is we're going to look at some of the data, and we're going to look at both some bullish and potentially some bearish ideas. So for those of you that have different views in the market, you can express those using options. More importantly, what type of option strategies can you use? So let's do a little bit of update on terms of where we're currently sitting in terms of COVID-19 trends. The good news is we do have a couple of countries in Italy and Spain, predominantly the countries that were ahead of all the other countries in terms of number of cases. Both Spain and Italy seem to have reached their peak, and they've declined a substantial amount since those peaks, showing us that the containment and medical things that these countries have done seem to be doing well. Germany and France at the moment are still, at this point, they're not going any higher. They've been somewhat stable for quite a few days now, and we're expecting that in the next few days that those countries also start to come down. The problem is that there are plenty of countries behind Germany and France that are still in their initial upstage, similar to Sweden. Sweden is certainly one of those countries. Sweden obviously taking a very different approach to other countries in terms of not locking down their citizens. They are seeing slightly higher rates of infection and deaths, but nothing that is out of the ordinary. So it does seem that the that Sweden's ability to contain this while keeping their economies open has been somewhat successful, but it is early days. The sample size is small. It is possible that Sweden still grows uncontrollably out of control, and they do have to lock down. So that is the downside risk that we do see in Sweden out of versus the other Nordic countries at the moment. But the markets so far seem to be not that worried, considering it's made it back up to that $1,500 level on OMXS30. It's been there for quite a few days. It hasn't broken out to the upside, but the markets are closed in Sweden. So we're expecting, we're going to have to wait till Monday to see how the markets digest the progress currently going on in Sweden. Sweden did have a peak yesterday of a little over 110 deaths. The day before. Yesterday it was a little lower, just below 100. But as you can see, there were multiple days in the past where Sweden looked like they were declining in terms of numbers, but ended up continuing to move higher. So it's hard to say whether or not this is just a temporary decline, or if Sweden is, does have this under control. But the data that I think I want to point users towards is some of the spending data. This, I think, is really gives us the insights into where people are spending their money, where they're not spending their money. And this gives us also a template as far as investors, where should we pay attention to, and where do we see the biggest skew between the data and where the stocks are currently trading. So this is Bank of America's credit card data going up until the end of March. This is, just so you know, this is credit card data for the US customers. However, I think the categories you're going to find are pretty relevant across the board, across different borders. As far as consumer spending habits, Sweden and the US, not too different from each other. There are some small differences. However, I think from the broader categories, we'll see trends that are going to be very similar, of which you're going to see stocks like airlines, lodging, cruises, entertainment. These are the stocks that have seen almost 100% decline. These are the stocks that are going to be slightly less impacted in Sweden, because in Sweden, restaurants are still open. Restaurants and bars are still open. So here in the US, we're seeing 50 to 60% decline. I would expect that in Sweden, that number would be slightly smaller, but I certainly would expect that number to also be lower than normal. Some of the bright spots in this particular category are online electronics and groceries. This has been a consistently strong area for this particular category. You know, as you can see, as people have been locked down, people have been stocking up on their groceries, online electronics. So those are interesting categories to take a look at. The other one that's really interesting is home improvement. Home improvement has been consistently fairly strong throughout this, and has not seen a significant decline in spend, but overall, total card spend down somewhere in the 30 to 40% range. So by most conservative estimates, we're seeing about a 30–40% decline in consumer spending. And that's really where we think the biggest risks to the markets are. So I want to point out a few ideas as far as how you can play this market utilizing options, knowing this type of data set exists. So first of all, let's talk a little bit about the environment that we sit in. Number one, implied volatilities of individual stocks are still extremely high. So volatility of individual stocks, the uncertainty as to where individual stocks will perform in the next few weeks, next few months, is extremely uncertain. However, the market volatility has fallen substantially. So when you have stocks that still have fairly elevated implied volatilities, but the market's implied volatility has come down substantially as the OMX S30 has increased in value, has stabilized over the last few days around that 1500 level. Liquidity has also improved a little bit. If we look at the bid-ask spreads of options, they are a little tighter than they were a couple of weeks ago. So liquidity also has improved. So in this type of market environment, where there seems to be a pretty, I would say, dispersed view of whether people believe that the market's going to higher or lower, in the fact that we have higher implied volatility, and higher implied volatility in individual stocks, slightly lower implied volatility on the overall market, there are two strategies that come to mind here. There's going to be selling credit vertical spreads. So if you have a directional view on a stock, and we're going to show you some examples of stocks that we think, based on the data, have some directional risk either to the up or downside, how you can utilize credit spreads to take advantage of this high implied volatility, to take directional views and really maximize the efficacy of a vertical spread or a credit vertical spread based on the high implied volatility environment that we have today. And the second strategy I want to point everyone towards is selling cover calls, because almost all of you are probably invested in some type of stock or perhaps even some ETFs that you own at perhaps a higher price, that you're currently losing money on that particular trade. You might want to try to recover some of that, and you certainly want to try to generate some income as the markets struggle to continue move higher. Cover calls, especially in this high implied volatility environment, provides a fair amount of yield that will provide some downside protection and provide an additional income stream while you wait for these stocks to potentially recover back to their to your original purchase price on those stocks. So I want to take a look at a few different examples here. So first of all, I want to take a look at H&M. And the reason I want to use H&M is because the credit card spend data that I'm showing you clearly shows that clothing is one of the most severely impacted industry outside of the travel industry. So the fact that the stock has declined substantially to that $100 level, but then rallied back up to 135 and has tried to break up of 135, but has really failed at that level multiple times, we think that there's a high risk that H&M is going to have a tough time continue moving higher, that it's more likely going to trade more sideways, especially given the outlook that not just here in the US, but globally, as far as when we will return back to normal. And until we return back to normal, we see clothing spend being a category that is likely going to be very difficult for these types of companies. So looking at H&M, and I'll pull up H&M here using OptionsPlay just to give you a live update. So again, H&M's rallied back up to that 136 level. Momentum is really slowed in that 136 level. Our thesis is that you have a bit of a trading range here around 135 or 136 and 100, that you're likely going to be somewhat range bound here in this particular range. So selling a credit spread is really ideal for this type of environment. Now, the thing about selling credit spreads is that usually we usually say that we want to collect about a third of the width of a credit spread. But what you're going to see right now, what's really interesting, is that because of the high implied volatility, you're actually collecting half of the width. So you're getting far more reward for this credit spread and far less risk, because normally you're collecting about 300, 350, risking about 650 is the type of risk reward that you're typically going to see on a credit spread like this. But here you're collecting 500 and you're only risking 500. And the break-even price here is 140. So the stock can actually move a little bit higher and still be profitable, even though you believe the stock is going to move lower. So you have a 60% chance of collecting $500 and a 40% chance of losing $500. So that's a trade that has a pretty good risk-reward ratio and a pretty good probability. And I just wanted to show you, how you can utilize options to your advantage in this particular environment, especially when volatility is high, using credit spread strategies like this. Now, this is just one example in a category where we're seeing a very severe decline in consumer spending. The next category I want to show you is a section where we've seen an increase in consumer spending, which is in the grocery section. So Axe Food, this stock sold off with the rest of the market, after that initial February sell-off, but has rallied back significantly, back above a fairly major resistance level. So let's take a look at Axe Foods here. The interesting about Axe Food is that for quite a bit of time, if we look at this, it had a pretty significant resistance level around 200 for a very long time. It managed to trade all the way down to about that 150 level traded all the way back up to 150, broke out above it, and is now back to test that 200 level. So you can look at this multiple ways, but the way that I'm seeing this, given the trends that we're seeing with consumer spending in groceries, the fact that it's back near this support level gives a very good entry for a potential move to the move higher. Now, keep in mind that grocery spend, I think in Sweden is less, the increase in grocery spend I would expect in Sweden is not going to be as high as the US, where predominantly I would say 60 to 70% of the US live in a city where no restaurants are open. So pretty much to get your foods, you have to go to a grocery store. That's not the case in Sweden. You still have restaurants and bars that are open. I'm sure traffic is down, is lower than normal. So grocery stores are going to see an uptick, but maybe not as high. So I don't necessarily know that I expect Axe Foods to break out to new 52-week highs, but I certainly think that you're going to find some support around this 200 levels. So again, we want to use a credit spread here to try to take this bullish view. The credit spread here is not as attractive as the one that I showed you before, because here on a 10-point wide credit spread, to try to collect 1/3 of that is 333 crowns. Here I'm collecting 340 crowns. So a little bit more than a third, which is still good, but not as good as, or certainly not as high premium as the one that we saw in H&M before. But this is a more bullish view that you might have on a store, on a stock in a category that clearly has seen substantial inflows or increases in consumer spending versus decreases that we've seen pretty much across the board in all other sectors. So this is a trade that I think you might want to take a look at if you were looking for some bullish opportunities in this market. And lastly, what I'll do is I'll leave you with a stock like AstraZeneca. And the reason that I want to bring up AstraZeneca is because right now there's a lot of uncertainty in the markets. Almost all companies that provide typically some kind of guidance as far as how they see the markets currently, how they see their business right now, what they're expecting going into the future. Pretty much most companies have pulled that guidance simply because it's too uncertain. It's too uncertain. They don't want to provide guidance that's likely going to be wrong a week from now or a few days from now. So, but AstraZeneca is one of the few companies, and partially because pharma is less susceptible to increases and decreases in consumer spending. Chances are if you need your medicine, you're going to buy your medicine regardless of what's currently going on in the world. So AstraZeneca is one of the few companies that have provided guidance, and the guidance isn't particularly strong, but it also isn't particularly weak. So it gives us a pretty good understanding as to where markets are going to be. So, and I think AstraZeneca, given the fact that they've provided guidance, the fact that the market, and I'll point out a few levels that I think are important. An important level that I think for AstraZeneca is about the 900 level, because prior to the coronavirus, it spent quite a bit of time above this 900 level, just trading above 900 level, broke down below it, came back to test it as resistance, pulled down all the way down to that 700 level, and is now back up to that 900 level, recently rejected. So now that we have guidance, we believe that AstraZeneca is likely going to trade somewhere in this particular range. We don't really see a strong move for the upside, a strong case for the upside, simply because AstraZeneca is not particularly in the running for any type of coronavirus type drugs. They don't have a lot of drugs that are likely going to make this a strong winner or loser. So we expect AstraZeneca to trade fairly in a sideways range going forward. So again, credit spreads are an ideal strategy for this type of environment. So same thing here. We were looking at a bearish short call vertical going out to May, looking at the 885, 945, which is a 60-point credit spread. This is collecting 2,500 crowns, which is which is almost a third of the width. So you're collecting 2,500 crowns in potential rewards. Your max risk is 3,500 crowns. That's if the stock goes above 945, which is near its 52-week high. So the stock would have to go above 945 for you to risk 3,500 crowns. As long as it stays below 910, you're going to be profitable If it stays below 885, then you're going to keep 2,500 crowns. So interesting strategy, in my opinion, to take a look at as AstraZeneca, after the coronavirus takes a big dip, comes back up as they provide guidance, which shows us that, you know, demand is certainly a little lower than prior to the coronavirus. But the guidance that they've provided is that the impact from coronavirus is fairly limited. So they're trading at a small discount to where they were prior to the coronavirus. You know, given the outlook, again, we don't anticipate that AstraZeneca is going to have a surge in demand in the next few weeks. This expires on May 15th, which is roughly 36 days away. So you really only have 1 month in time. And as long as Astra is going to stay relatively sideways, you'll collect 2,500 crowns. Worst case scenario, AstraZeneca rallies significantly. You're risking a little bit more than the reward that you collected. So those are some of the strategies that we're currently taking a look at. And I wanted to highlight for you so that you guys can see how we're thinking about this market, what type of option strategies that we are employing in this particular market. And lastly, what I'll do is I'll just leave you with, you know, thinking about the stocks that you own in your portfolio, stocks that you may have lost some money on. So let's just go back to H&M. And I'm bringing up H&M because I'm presuming that many of you may own this stock in your portfolio. So if you own H&M stock in your portfolio, you might be saying to yourself, well, you know, I own this stock, but I'm underwater on the stock. Maybe you own it from 180, 190, 160. Maybe you bought some as the stock fell, and you want to try to get yourself back to recovery, or at least start earning some income while this stock kind of trades sideways, and the outlook of the clothing industry is fairly, I would say, subdued going forward, given the trends that we're currently seeing from that credit card spend. So what you can do is you can utilize cover calls in this particular example. So let's say you use the income tab of OptionsPlay. We'll show you which cover call to sell, the May 8th 150 calls. This is collecting 135 crowns. That's just the bid price. The mid price is 175 crowns. And what you'll see here is you're going to collect 1.28% of the underlying stock price in 29 days. Now that comes out to be a 16% yield on your H&M stock. Now H&M stock already pays a pretty nice 7% yield. Now part of that 7% yield is because the stock price has declined in almost half in the last year. But if H&M is able to sustain this dividend, which I have some concerns that they may not be able to in the current environment that we're in, but even if they do, you're looking at doubling your dividend yield by adding a covered call to it. So in this type of market environment where markets may move a little higher, may move a little lower, and predominantly trade sideways, cover call is a great way to add yield to your portfolio, turning your H&M yield from 7% to roughly 23% by adding cover calls to it. Now, again, these yields are elevated because the markets are very volatile. The implied volatility of individual stocks are very, very high. If you own stocks like Axe Food, let's just use Axe Food real quick. Axe Food will generate a little less yield. Here, as you can see, let's also use the midpoint here is two crowns, a little over 2 crowns here. So 2 crowns is about 1% of the underlying stock price in the next 36 days, which annualizes out to 10% yield. But Axe Food only pays a 1.7% dividend. Grocery stores typically do not pay high dividends. So by adding a cover call to your Axe Food position, you're increasing your yield from a little under 2% to 12% by adding cover calls to it. So especially in this type of market environment where perhaps you think that it's going to take the market a bit of time to get back to normal, these are the types of strategies that you want to utilize. And we really created this tool so that you can click on any symbol that you own stocks in and quickly see what expiration date and what strike price, how much income can you receive, how much yield is that. So here in Securitas, this yields 3.88% dividend yield. The cover call only yields 4%. So in this particular case, this might be a less attractive cover call. And you might say, well, you know what? I don't want to give up my stock or potentially give up my stock at $125 for just 4% yield. Maybe I won't write cover calls on this particular stock. and move on to the next one. You don't have to spend hours and hours researching opportunities in the market using an option chain. This tool is designed to make that process as simple as possible for you. So with that, that covers what I wanted to show with you here today. I hope that you guys find this useful in understanding how to position yourself going forward, looking at the markets, whether you see this as kind of a V-shaped bounce and the market's going to continue moving higher, or you think that market's going to continue moving lower. Different ways to play that utilizing options. So with this, what I'll do is I'll open this up for Q&A. If any of you have any questions or some symbols that you want me to take a look at, I'm happy to take a look at them and show you my thoughts on them. But I hope that this was useful in helping you frame your thought process and in your trading for next week. So if you have any questions, please type them into the chat window at the bottom of your screen. Great. Ali's asking a great question, and we've been getting this question quite a bit. And Ali's question is, should we get into oil or energy stocks right now? My take on that is not yet. Simply because with oil currently trading at, oil did recover quite a bit, but it's still trading only at $25. So, pretty much that jump that we had yesterday, we've pretty much given back all of those gains. At $25, pretty much everyone outside of the major oil companies cannot be profitable at these prices. So we expect that in the next few weeks, in the next few months, we're going to see more and more bankruptcies in some of the weaker names, especially names that have weaker balance sheets. Many oil companies can, especially the shale and fracking companies, cannot be profitable unless oil is back in the $40, $50 range. So we expect that there's going to be mergers and bankruptcies in this particular space. If you're going to play in this particular space, we think the midstream companies are potentially the ones to continue to potentially play. The large companies like BP, Exxon, those are the ones that are likely going to survive, but the small ones we really think are not a good idea at the moment. Energy still remains one of the weakest sectors in the markets right now. So great question, Ali. Any other questions? How about cruise stocks? Great question. Also similar, very similar. So here's, the way that I look at cruise stocks is similar to the airlines. And if you can see here, we actually have some data on cruise lines. Whoops. Whoops, sorry, I just closed that. 1 second. We have some data on cruise stocks, and the spending across the board here is pretty dismal. As you can see, the spend is actually over 100% decline. And the reason that you can have negative numbers below 100 is because the cruise line companies are actually not only losing money, are not only not getting any revenue, they're having to issue refunds. So, when we look at airline traffic is still declining. So even to this week, we're still seeing declines in travel. So until corporate travel starts to come back, and leisure travel is usually a few weeks behind it, we don't think it's time to get back into some of the cruising stocks. Sorry, I highlighted the lodging, but I meant to highlight the cruise one, which again is still pretty much 100% declines. So we don't think, based on this data yet, that it's time to get back into the cruise lines just yet. I hope that answered your question, Ali. Any other questions? Francois is asking, is this recorded? Yes, these will be recorded, and I will send you the recording after we finish here today. Any last questions before I sign off? If there are no other questions, please. Great question. How can it be a negative? It can be negative when the company has to issue refunds. So this is spending, right? So if in 100% decline, that means no one's spending a single dollar. When it's a negative 120%, not only are people not spending, but the companies have to actually issue refunds that they previously counted as revenue. So that's how you have negative 100. What strategies could be interesting if you are not holding stocks? So I think the strategies that I just explained to you, the H&M credit spreads, Axfood credit spreads, and AstraZeneca, those are the strategies that I would utilize in this particular market environment if you have bullish or bearish views on some stocks. And I'm making a case for H&M because of the clothing data that we're seeing. I'm making a case for Axe Foods because of the increase in grocery spend that we've seen. And then AstraZeneca, one of the few companies that have provided guidance that gives us a sense that, where they're currently trading is fairly priced, and we don't see any catalyst to see a strong bullish or bearish case for AstraZeneca. And again, selling credit spreads, which is more of a neutral strategy, is a great strategy to trade in that type of environment. So we think credit spreads are the strategy to trade in this particular environment. Any other questions? Francois, so that is a US-based company. We're here to just talk about the Nordic symbols. UVXY, first of all, is a leverage volatility ETF. I don't touch those, I'll be honest. So I really don't have much to comment on that, unfortunately. Any other questions about the Nordic region, Nordic symbols, Nordic economic data? Okay, if there are no other questions, I just want to thank everyone for taking the time out here this evening. I hope that this was useful in framing how to go about looking at the markets, what research we're paying attention to inform our decisions in the markets, what strategies we're deploying here based on the volatility environment that we're in that can maximize the implied volatility right now, which is predominantly going to be in selling option strategies. So especially if you don't own any stocks, credit spreads are a great strategy. If you do own some stocks, selling some cover calls on stocks that you own or selling put options on stocks that you want to start to purchase at these levels, those are the strategies that I would focus my attention on here today. So thank you so much. I hope you guys have a great evening, and I will send out the recording to everyone in a few minutes.